Okay, I'm going to just walk through some of these consolidation problems that are less than 100% owned by the parent. So all the work is done. I just want to verbally explain it a little bit. This top couple paragraphs is what you do need to understand. If it is an upstream sale, the sub sells to the parent, the NCI shares in all of those adjustments. So we're going to adjust our subs net income to calculate out the income to be split, and then we're going to split it to the parent and the NCI. Downstream, when the parent sells to the sub, the NCI will not share in those adjustments. The NCI has nothing to do with the parent. The NCI is stockholders of the subsidiary company. So the parent's financial statements are of no interest to them. So if it's the parent to the sub, the only person that's interested in those adjustments is the parent. So then we take our equity income and we will subtract out like our amortization and our depreciation, anything else that would be upstream. Then we're going to split the income. Then the parent would get the adjustment for any of those downstream sales. So that can be confusing to students. So jot that down and try to have it make sense to you. So here is a basic exercise. So we've got the parent is owning 70% of them. So the NCI owns 30. There is excess of acquisition accounting premium assets that were a building estimated to be undervalued by $390,000 and a patent $260,000. The building's depreciated over 20 years. The patent's depreciated over 10. And then they give us the subsidiary's net income right there. So then they're asking us to compute the income and loss from the subsidiary to tie it out to that $150,150 that we see on the parent's books. So we start with the sub's net income. We subtract it for the depreciation and the amortization of those acquisition accounting premiums, and then we split it. 70% goes to the parent, 30% to the NCI. Then they also ask us, we'll put together a consolidated income statement. So then you can see we add our sales across, we add our cost of goods sold across, calculate our gross profit. The operating expense is going to be the parent plus the sub, but then also plus the depreciation and amortization that we show up there, the $19,500 and the $26,000. Then we come down to our consolidated net income, and then we subtract the NCI's piece of it. So again, go look back up at the split. The NCI gets $64,350, at least attributable to them. So we subtract that out to get to the parents, and then we double check that that equals our parents' net income. So go back up to what they give us, and it does. So we still have that nice double check, and it lets you know if you did the split right, because then you'll be able to tie it out. Okay, then we have, again, preparing the consolidated income statement, and now it is still upstream though, but we have an intercompany gain, an unconfirmed upstream gain. Okay, so we have, as we read it though, again, the parent has 75%, NCI has 25%. The building has $108,000. There's a customer list at $48,000. The building is depreciated at 10 years, customer list at 5 years. So that'll calculate out our depreciation and amortization. During the previous year, the subsidiary sold to the parent a piece of depreciable property. The unconfirmed upstream gain on this intercompany transaction was $36,000 at the beginning of the year, and the upstream gain each year is $9,000. So basically, they amortize out that gain because of that change in depreciation expense that we talked about in Chapter 4 by $9,000 a year. So we go down and they give us the income statement for each of them. So we want to figure out how we go from the $180,000 to the $126,400 and then prepare the consolidated income statement. So again, we start with our subs net income of 180,000, calculate our depreciation and amortization on those acquisition accounting premium assets, subtract that out. Then here is our upstream additional depreciation. So if you remember back to chapter 4, if it's upstream, the sub sold to the parent, so then the parent is now depreciating this extra amount of the asset by $9,000 a year. So in our I entries, we have to reduce that depreciation, and then it's an adjustment here to the subs net income, because again, we have to add that back. And then since it's upstream, the sub sold the land to the property, plant, and equipment to the parent, the NCI shares in it. So then we calculate out our net income. 75% goes to the parent, which again ties to what's on their income statement. If we go back up there, the 126,450, and then the 42,150 goes to the NCI. And again, same thing as we did the last one, add the sales across, add the cost of goods sold across, add the operating expenses, but include those D entries, and then also adjust it for that adjustment to the depreciation of that gain, that $9,000. And then we subtract out the income attributable to that NCI, and then we equal the parent. So again, you can go back up there and double check that. But the 906,450 is always our double check. So you always want to double check those to make sure you did them right. All right, now we get into two big problems. So there's going to be intercompany inventory sales. The first one, it's going to be upstream, which means the NCI shares. The second one will be downstream, which means they do not share. We have acquisition accounting premiums that we are amortizing and depreciating over those useful lives. They give us the consolidated income statement, earnings, and balance sheet for each one. And then we come down. So I don't always do exactly what they asked me to do, because they go through those 6 steps. So I kind of do some of them, but not all of them. So I always start with the reconciling of the subs net income. So the 250,000 is coming right off of the subs income statement. Then I'm calculating out what's that depreciation and amortization on those acquisition accounting premium assets. Again, they're given to us up in that first table, these ones here. Okay, then I look through my inventory adjustments. So I have gross profit that was at the end of last year, $25,000, that I get to recognize this year. And then I have 52,500 that I have to defer until next year. So I'm going to add the 25,000 because I get to record that now. It gets to be recognized. And then I'm going to subtract the 52,500 because it's not yet sold. It's in my ending inventory. Then that gives me 165,000 that I'm going to split based on the percentage that's owned by the parent and owned by the NCI. And then this 15% that goes to the NCI is going to end up as that line item on my consolidated income statement. And then this ties out to what the parent. So we'll double check that. 140,250, 140,250. So always do that step and double check it. Then I always reconcile out the equity investment. And when I'm doing this step now in chapter 5, I add the NCI because they go hand in hand. So I pull the common stock, paid in capital, beginning of the year retained earnings off of the balance sheet. And then I split it though. So I add those up, split 85% to the parent, 15% to the NCI. Then my A entries, now notice though, this is, taking us back to, I think chapter 3, but make sure you're looking at your beginning of the year values. So it's been 3 years since the acquisition. So we have to account for 3 years of the depreciation. So 3 times that 25,000, 3 times that 32,500. And then we subtract those out to get to the beginning of the year values. And then we split those 85% to the parent, 15% to the NCI. Then the C entry, I kind of set up a little bit differently. I do it for each one. So the parent has their equity income less 85% of their dividends, of the subs dividends that they get, and that gives me the total that goes to the equity investment. Then I come down here and I say, here's the net income applicable to the NCI that we just calculated to the left. And then I subtract their 15% of the subs dividends, and that's the amount that goes to the NCI. Then our beginning inventory is that $25,000. Well, that too has to be split. So 85% to the parent, and then 15% to the NCI. Then I use those to create the journal entries. So really, again, I'm hoping that these journal entries are reviewed to you. The only thing that's new in this chapter is our credit gets split 85% to the parent, 15% to the NCI. Same A entry, 85% to the parent, 15% to the NCI. The C entry, again, pick it up more off of kind of how I mapped it out up in that first one, so you can kind of see it. But some of the basics are, we are eliminating our equity income completely. We are eliminating the dividends completely. We are setting up that net income attributable to the NCI that we calculated. And then the differences are going to go what I mapped out above to the equity investment and then the NCI. Our D entry is the same as always. Our I sales entry is the same as chapter 4. The I ending is the same as chapter 4. The I beginning is just a little bit different. The credit is still going to cost of goods sold, but the debit we're going to split. It doesn't all go to the equity investment. It gets split between the equity investment and the NCI, assuming again that it is the upstream sale. And then our I payable is the same as chapter 4. And then there it is all put together. You can see all the yellow. It's still all of our double checks work. We have the new line item to the NCI, net income wise, and then we have a new line item for the NCI down below here in our equity section. Now then this one, what makes it a little bit different is that it is a downstream sale. So the parent sells to the sub. So we still have an acquisition accounting premium to deal with. We still have the intercompany sales and the beginning inventory adjustments and the ending inventory adjustments, but it's where do they split? So if I can kind of go down to that, so when we reconcile out our equity income, we start with our subs net income. So again, the $260,000 is going to be the subs net income. I'm going to adjust it for the depreciation of that one acquisition accounting premium asset. So again, what's given to us up here, $208,000 divided by 10 years. And then at that point, though, is where we do the split, because that's the only thing the NCI shares in. So then we say, okay, 70% of that goes to the parent, 30% of it goes to the NCI. But then the parent still has the remainder of those adjustments because it is a downstream sale. So then they have to add, they get to add their gross profit that was deferred last year. So again, if you go back up to that table, that is the $31,200. And then they have to subtract the gross profit that's deferred this year, so the $11,700. And then that ties out to their equity income. The $186,940 again ties out to what they have on their income statement. So if you tried to do the inventory before the split, you're not going to tie out, so that should clue you in. Then I set up this exact same way as we did in the last problem. Go through your E, split it between the parent and the NCI. Your A at the beginning of the year after 3 years of depreciation, split between the parent and the NCI. Do the same thing with our income, equity income less the parent share of the dividends is what goes to the equity investment. The NCI, net income attributable to the NCI less their share of the dividends goes to the NCI equity account. But then now the entire beginning inventory adjustment does not get split. It's all in the equity investment because, again, the NCI has no interest in it. So then I use those to build the entries. So again, very comparable for our E, our A, and our C as to what we just did in the last problem. D entry is the same as always. I sales is the same as the past chapter. And actually, so I end and I begin are all the same as the past chapter because it is downstream and the NCI is not sharing. So actually, that one's a little bit easier if it makes sense to you. So again, just kind of look that over and double check that. Then here we come in to put it all into our consolidated balance sheet. And then all of our double checks are still going to work as they always do. So take some time to kind of understand those entries, see how they're nicely put together. So that is a walkthrough of those in-class problems.